It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Hong Kong and mainland China stocks lose momentum after investors were left disappointed by the government's latest moves to support the economy. The worries over China seeping into the commodities markets, with oil seeing big drops. Traders also keeping an eye on the tensions in the Middle East. And Ratan Tata's half-brother Noel appointed the new chairman of Tata Trusts, the collective of charities that indirectly controls the $165 billion Tata Group. Taking a look where we are in terms of markets, it is about China on the back of that briefing we had over the weekend. Volatile session in China. CSI gaining as much as 1.5% early in the day. It's given up most of the gains. We're seeing higher volumes. Investors mulling China's promise of more support for the property sector. Also, government borrowing to boost the economy. Banks, property plays pretty much in place. CSI 300 index currently up 0.3%. Worth noting, China's entrenched deflationary problems. We're on watch for trade data, by the way. Export growth probably slowed. Imports barely above zero. We're tracking the yuan as well, the fixing within 1 pip of estimates. PBOC probably wanting to manage yuan moves against the vol in China stocks as well as bonds. We're also tracking the yen currently at 149.31, inching ever closer to that 150 mark. Now, China's highly anticipated finance ministry briefing on the weekend lacked the firepower equity investors had hoped for. Beijing's promising more aid for the slumping property sector and indebted local governments, but economists aren't convinced it is enough to defeat inflation. For more, let's bring in our China correspondent, Min Min Loh in Hong Kong. Min, pretty much disappointment.
Yeah, well, I think the big disappointment was that we didn't get that big magic number. But I have to say that 2 trillion yuan that investors were expecting, that is possibly still on the table, because any revision to the budget or new additional bonds on top of this year's quota, that has to be approved by China's legislature. So we may still hear that later in the month when the NPC Standing Committee meets. But meanwhile, the Ministry of Finance have given us a series of measures that they plan to take, and that includes issuing new special sovereign bonds to inject liquidity into the banks, because not that the banks are lacking in capital, they're highly sufficient in that, but it could help ease off the margin pressures on these banks as the PBOC calls for cuts to mortgage rates and also cut the key policy rates as well. Other things that the ministry are doing include widening the usage of local government bond funds to allow buyback of homes and buyback of idle land to convert these homes into social housing. Now, this could help speed up the take-up rate for that home repurchase program. And the other thing that they're doing is to increase the local government debt quota in a one-off debt swap. So essentially, this would help alleviate the pressure that local governments feel to repay their debt. It could help them expand more spending to actually revive the economy. And I think the big disappointment from this press briefing is the lack of specific measures targeted at boosting consumption. There was mention of cash handout in the form of doubling the quota of scholarships for college students and increasing the financial aid there, but not anything to the tune of a massive scale that investors are looking for. And that was the missing piece, I think, that we didn't get from the Ministry of Finance briefing.
China continues to want to allay concerns. Yet another briefing to support perhaps businesses this time round. What are we hearing?
Yeah, we didn't hear any huge new policies. It was more of micro policies to support the private sector. Some lines around, leveling the playing field for private businesses, because state-owned enterprises especially still enjoy some sort of implicit advantages when it comes to government procurement contracts, for example. And also support from various government departments to help merchants in areas including taxes, social security, employment and financing. But of course, the key is how these measures challenges play out when it comes to implementation. The ministry also talked about speeding up refund for illegal charges that the government has slapped on private businesses, and this comes as local government has been slapping decades-old fine to try to claw back more revenue at a time when their tax revenue and land sales revenue has been declining. So these are some of the incremental measures, I would say, to help shore up private sector confidence.
Min, deflation pretty much entrenched in China. We're awaiting trade data to give more indication of the state and health of the economy. What are we anticipating there?
Yeah, well, trade data in terms of exports, that's expected to slow to 6% in September compared to 8.7% the previous month. Imports expected to grow by 0.7%, but still hovering below that 1% level, again reflecting that weakness in domestic demand and this two-track recovery that we are seeing where China relies heavily on export-driven growth, but that is also facing headwinds given some of the trade tensions that we're seeing as well.
Min, thank you so much for that. Bloomberg's China correspondent. Min Lo, let's delve deeper into the Chinese market. Jun Li, CIO at Power Sustainable Investment Management, is joining us from Shanghai. Jun, I'm just wondering your thoughts on how the reaction has been. We saw an uptick of 1.5%, but those gains almost gone.
Yeah, I think overall I am a little bit more positive towards the takeaways of the MOF meeting on this Saturday, because I think this is one of a basket of stimulus packages that the Chinese government is considering to help the economy. There's always a debate about whether this is to mitigate the risks or whether it is able to accelerate the growth of the Chinese economy. But from my point of view, I think it is important that we do see at this moment a basket of stimulus packages to sustain the economic growth and helping solve some of the fundamental issues in the economy, such as the local government debt issues as well as the property market stabilization. I think from a top-down point of view, we do think that the Chinese government really wants to stabilize the property market, really wants to help resolve some of the debt issues, and really wants to help the consumers. However, I think the market reaction seems to be, on the slightly disappointing side, largely driven by a few things. One is I think market had a really high expectation. So the market had a strong rally in early October. Look at CSI 300 index. It rallied about 40% from its trough. That's way ahead of the fundamental of the listed companies, right? So it is natural to see a little bit of cooling down of the so-called overheated market for Chinese equities at this stage. But I think the policies really paved a way for the next, couple of quarters of recovery. That's important.
June, it is also about the fiscal stimulus that people are looking out for. And the government has said it is able to raise its fiscal deficit. The question is really by how much? I mean, there's some indicating perhaps 3%. Is that enough?
I think it is generally acknowledged that we probably need more to really stabilize and accelerate the economic growth. The government did not give a specific number during the Saturday meeting. However, I think they embedded in their messages, I think there's still 1 to 2 trillion of capital in the local government fundings, solve the debt issues, funding their shortage of fundings. There may be another 1 to 2 trillion in the property market stabilization, buyback of the land, etc. So embedded in the conference messages, there are 3 to 4 trillions of capital injections. However, I think it is consensus that more definitely will be needed in the next 2 years to sustain a more smooth recovery.
June, we're showing the estimates for GDP for a lot of the top banks that we're tracking. Goldman saying that it's raised its GDP target for the year to 4.9%, but it's still below the 5% that China itself is targeting. I mean, what do you make of China's conviction that it will get there?
Yeah, I think a 4.9% GDP growth or a 5% GDP growth is in the ballpark range. So I think the Chinese government's guidance is around 5%. So we also see Goldman Sachs raising the GDP growth this year to 4.9% this morning. I think it's largely driven by the fourth quarter recovery based on the stimulus packages. I think investors are still looking into what is beyond the fourth quarter and looking into 2025, how sustainable and how well these policies will be implemented.
June, in terms of market narrative, there's a sense that China wants to control that narrative, not wanting what we saw in 2015 yet again. I'm just wondering, how do you play this market right now?
I think different investors are looking for different they have different outlooks. So for us, I think first of all, we are looking at a relatively midterm to long term. We hope to see the Chinese listed companies can gradually recover their ROE and improve their earning growth, because we really believe those are the fundamental drivers for a stock market rally rather than the short-term volatilities. The second is that I think in the short run, investors still need to notify there are a lot of short-term risks in the market. For example, I mentioned that the market seems to be overheated. The second one is that the third quarter earning results are going to come out. I think it's very important for us to see whether companies are able to guide a stronger, earning confidence in the next quarter or in the coming year. The third one is definitely about the U.S.-China relationship, the U.S. election. So in face of a lot of risks and uncertainties, we do anticipate that the market may have more volatilities. So the areas for investors to really look at is for a certain level of certainty. For example, I think investors still need to look for dividend plays. Investors should look at areas where the third quarter earnings seem to be solid, and the investors should look at areas where the stimulus packages are going to benefit. So areas like the property market, financial sectors, consumptions, other areas that investors need to look at. But honestly, I would say that the valuation at this stage is at a fair range. So investors also need to be they should not be overly optimistic, but really looking on the fundamentals of the recoveries of the companies and their earning qualities.
Right. As you said, June, there are risks. How do you hedge against the risk, bearing in mind that some are saying that perhaps you won't see an improvement in the economic data till spring 2025, so it's going to be a volatile ride?
I agree. It's going to be a volatile ride. I think even if the policies are well implemented, it still takes some time to see the results and to see the improvement of the macro data. So for us to really look at it is really try to buy companies that are at a good valuation, and try to buy companies with a certainty on the earning growth outlook.
Look out for the fundamentals. June, thank you so much for that. June Lee, CIO at Power Sustainable Investment Management. Now, still ahead this hour, we'll be looking ahead to India's latest CPI print with MK Global Chief Economist Madhavi Arora, who expects a pickup in inflation for September. But first, Robeco's head of Asia Fixed Income, Tuha Chow, will be joining us for a closer look at China's credit markets as investors digest the latest stimulus news out of Beijing. Keep it here with us. This is Bloomberg. We'll talk about volatility in the China market on the back of that briefing we had over the weekend. And of course, we're awaiting that trade data out of China as well. Let's get insights into how markets performing. Avril Hong is on top of that. Avril.
Yeah, we have a lot to digest as far as China is concerned, but something I wanted to highlight first, because today out of the Lion City, we did get those GDP numbers as well as the decision from the central bank. And the MAS essentially is bucking the trend, this global wave of easing among central banks as it left its policy settings unchanged. This was as expected, but it just goes to show you how the worries about inflation still linger. They are somewhat elevated here in Singapore. We also had data that showed that growth accelerated, and shortly after that decision from the central bank, we saw the Sing dollar moving off session lows against the greenback. Let's rake through what we're seeing in China. In terms of the currency, we've been seeing offshore, onshore yuan both weaker today, but perhaps what was more interesting is what we got from the PBOC in terms of signaling. If you look at the fix, it was just 1 pip away from traders' estimates and below where offshore yuan is at above the 708 level. And to the likes of our MLife strategist, Mark Cranfield, he thinks this tells us that the PBOC is trying to curb volatility at a time when you're seeing enough of that in stocks and in bonds. And speaking of which, let's take a look at how we are seeing the curve today in China, where 1s, 5s, 10s, 30s, they are moving as well. We're seeing gains across the board. In general, we have been seeing that selling in bonds easing off as the stock market rally has cooled. We also have the likes of HSBC saying that over the weekend, we got something for the bulls and the bears. If you're passing what we got in terms of stimulus, maybe if you're an optimist, you look to how there's this forward guidance on additional bond issuance. But it was also light on details, light on the timeline. We didn't get anything in that direction. So something for the bulls and the bears when it comes to the rate market. This could mean that things remain range bound for the time being.
Of course, investors have been chasing that rally in China. Avril Hong, thank you so much for that. Let's get market perspective with Tu Hao Chow, head of Asia Fixed Income at Robeco. What are your thoughts on the market reaction in China? We've seen how those gyrations have impacted the bond market in particular.
Yes, I hope that. I think some of the stability is actually good. As you say, it's been quite a straight line. And I think the kind of more tempered approach that's come through, as you say, and something for the bulls and something for the bears. But I think overall, I think this... But what's very clear is a change in direction, which, even if you can't get excited about the big number that we were hoping for the weekend, you can start to kind of digest that they are trying to tackle some of those underlying bottlenecks that actually you need to sort out even before you actually throw more stimulus at the problem.
So is it time to perhaps tweak that strategy in China? How might that look like?
I think it's definitely one as the volatility is going to be there. So I think people getting too excited, the market tends to kind of overshoot itself, pricing too much in. But actually what the message is that it's going to be a much longer term trajectory, and it's much more to do with much clearer direction, much clearer stabilization. So I think, again, imagine if it was a very kind of big number, the bond market would have had a bit of a hiccup that side, even if the equity market was happier. So I think that balancing act is going to be quite important, both on the fiscal side, but also how much bond issuance that would be put into the market, and the ability that to be absorbed by the market is also as important.
We know that investors have been chasing the China rally. What might that mean for the bond market in China?
So I think here, this is where the lack of clarity on how much issuance that's going to be done centrally versus locally, that's still kind of a big question. But I think it's very clear that that the more support will be given to local governments and then some of the balance sheet usage is going to come from central government bond issuance. But how much that is and how much that's priced and that put through to the market, that's also going to be quite important. And how much of the banks can, with their balance sheet, absorb any new issues that are coming from the central government is also going to be quite critical. So there's a lot for investors to digest and think through the implications. But I think a balanced outcome has actually been much something that we actually wanted from this announcement.
We talked earlier about how we've seen volatility in both Chinese equities as well as bonds, prompting the PBOC to want to perhaps manage the movements in the currency. How might this play out in terms of other Asian currencies? We've seen how the Aussie, for instance, got hit today.
I think those currencies that are definitely kind of looking for more stimulus from the more commodity type of names, they're going to obviously have been a little bit disappointing from a lack of a big fiscal stimulus. But I think for the rest of the kind of Asian Southeast Asia in general, I think the view that growth will be picking up, exports and a trade within the region can still be actually quite positive. I think those are the things to look out for. And I think on the commodity side, I think we had overshoot a little bit on expectation, and some of those commodity and then the commodity related currencies will have to take a bit of a back burner for now until we get a big number.
The risk out of China. That's right. The risk out of China. Also, the risk out of the U.S. Election that might just impact emerging market currencies in particular.
I think so, and I think that's what now that this has calmed down, what we'll be looking to next with the election coming very close. Who will win, what those implications, and for which sectors. These are also very specific bottom-up questions that we need to be kind of digesting. And of course, the EU, again, trade tensions there are also going to be putting a lot of pressure down on some of the trade data that you're talking about coming out of China. So there's a lot of different moving parts that for us to digest at this stage.
Tuha, before we let you go, the euro, of course, we're expecting the ECB to cut rates 25 basis points. Which are the best crosses for you to be playing when it comes to the euro?
We actually think that they're not likely to move in October, probably in September. Again, inflation there being a bit of a problem. On here, I think we probably... actually, we quite like the thing. I think what the MAS has done there this morning again, bucking the trend a little bit and actually having a bit of resilience. Again, watching out for the Southeast Asian countries that actually maybe, particularly the ones that will be benefiting from anyway, a wobble in China, but actually still trade in general in the region to be quite good, but not so much commodity orientated.
Thank you for your insights, Tuha Chow of Robeco. And you can also turn to your Bloomberg. For more on the Chinese market reaction to the government's steps to boost the economy, go to TLive Go to get commentary analysis from Bloomberg's expert editors. Plenty more ahead. Keep it here with us. This is Bloomberg. Welcome back, and here are some of the corporate stories we're following. Hong Kong's biggest real estate developer, Sun Hung Kai Properties, says it has sold all 238 units at its Cullinan Sky project. Units in a development in Hong Kong's Kai Tak district sold for an average of more than $2,900 per square foot. The market is keenly watching apartment sales in Hong Kong for signs rate cuts might help ease the city's property slump. Chinese EV maker BYD is working on its strategy to woo European buyers. Executive Vice President Stella Li told the newspaper the company may initially offer EVs in Germany for about $27,000 to $32,000. The plan comes after the EU this month voted to impose tariffs of as much as 45% on EVs from oil. In the markets, we're tracking oil on the back of that briefing out of China, as well as developments in the Middle East. Oil under pressure after rising for 2 weeks. Combination of that China deflation risks, stimulus disappointment from the weekend, along with relative quiet from geopolitical issues. Brent crude trading at 78.14, down by more than 1%. New York crude also down as much. And in Hong Kong, as well as China, we're tracking China banks as well as property on the back of the announcement we had over the weekend. We've seen pretty volatile session, but investors mulling China's promise of more support for the property sector, also government borrowing to boost the economy. China Ag Bank up by about 4%. China Resources Land up by 6.5%. Plenty more ahead. Keep it here with us. This is Bloomberg.
what's interesting is that for the past kind of, I guess, 2 years or so, global investors can just forget about China. Now, with this kind of like stimulus and this round of policies, you can't ignore China anymore. If you look at like the manufacturing PMI is still below 50, so I mean things are still rather weak from a cyclical perspective. However, if we look kind of forward to 2025, we think that that part of the economy is going to start to recover, and that could actually prompt good inflation to kind of go up higher.
And that was Stashaway Chief Investment Officer Stephanie Leung speaking to us on the China Show. Let's get to markets. Avril Hong on top of developments. Avril.
Yeah, Has. As we watch China markets on the mainland about to head into the lunch break, of course, it is all about what happened or did not happen over the weekend with a briefing from the Chinese Finance Ministry. We didn't get that headline dollar term number in terms of additional fiscal stimulus, but what we got was some of these pledges of support for the property sector, for local government debt, and in some ways, to some, this means a signal of support that at least there is a silver lining in terms of stimulus, and it is also showing us where the focus for the government is, what its priorities are likely to be. And you have the likes of Goldman as well, for example, upgrading their forecast for the GDP this year and the next, as they think that this is a turning point of sorts in terms of cyclical policy management. Now, it's interesting to see today this divergence of sorts. The mainland stocks are the ones that are gaining about 1.5%. We are seeing the Hang Seng back from that long lunch break, or that long weekend, I should say, and declining. This divergence is interesting because if you flip the board, the other dynamic that I wanted to highlight is what we're seeing in terms of one gauge of the premium of A shares over H shares, and it shows you where it's trending. To some of our analysts, this is something that has further room to run. You think about the direction or the focus of stimulus, it is targeted towards the sectors on the mainland. So this is something that we could see a lot more of going forward. Flip the board again. I wanted to highlight what we're seeing in terms of China proxies as well. To some, what we got over the weekend is lacking a clear direction. There's not much consensus as far as some of these commodities traders' perception of what we got is concerned. We've seen how commodities have overall been gaining ground or recovering since late September. Today, we're seeing iron ore moving up a touch. We are seeing some of the Chinese-sensitive currencies losing ground, such as the Aussie and the Kiwi dollar, Has.
Well, the question is it a false dawn again? Avril Hong, thank you. Let's get more analysis on China's latest measures. Bloomberg Chief Asia economist Chang Shu joins us from Hong Kong. Bloomberg M Live Executive Editor Mark Cudmore is also with us. Chang, let's start with you. We know deflation is front and center, is the focus, yet the policy is just still not enough.
I have relatively sort of positive take on the stimulus. We never expected. We've been consistently saying there's unlikely to be new money coming in by the end of the year because there's a large amount of unspent budget because of the difficulties at the local level to implement those budget plans. We think at this point the MOF briefing shows that the government is focused at this point on unclogging the economy. Is focusing on two things. First of all, to really get local government going to deliver the quite expansionary fiscal policy set at the beginning of the year, and secondly, to focus on two core issues that's stopping the economy going, namely the local governments and the property market.
So some optimism there, and Mark, perhaps for some, that promise alone of additional fiscal stimulus is good enough for them to be buying into this market.
Yeah, absolutely has. I very much share Chang's optimism around this, and I think actually the Bloomberg economics team have been excellent in their analysis of calibrating the expectations right for what we should expect out of these announcements. I think the point is that we don't need another massive stimulus injection. We do need, as was the term there, an unclogging of the system. We do need some better targeted measures to facilitate not just a bottoming out of the property sector, but also a boost of the private tech sector. We've got some of those measures today. Sure, this isn't the big bang number, but again, people are keep on looking for just extremely crazy outsized gains. Our expectations have been elevated so much by the moves of the last month. The fact is, China-Hong Kong stocks are all up significantly from a month ago, and they will be up significantly again over the coming months. These are very consistent measures over the last couple of weeks. Most importantly, all the highest levels of China's government are united in making very clear they are going to get the stock market higher. They are going to make sure that this is a bottoming of asset prices. And that is the clear message. This is a command economy. This is a state-run economy. And when they send that signal, they will succeed. They've got many tools left to do. They could do a bazooka stimulus if they really, really wanted to. But that's not where the need is, as Chang Shu's team has outlined.
Well, what's consistent is that it's been holding pressure after pressure after pressure. Chang, the thing is, when it comes to data, that economic data isn't likely to improve till maybe 2025. Some say spring of 2025. What can be expected from now till then?
Yeah, I agree with you. I think this time the government is showing its determination to turn the economy around, to lift growth and get the economy out of deflation, and is likely to take measures, coordinated measures across monetary policy, fiscal policy, housing, support for the stock market as well. But I think a couple of things might have changed. One thing is they might be careful in sort of pacing the stimulus. It's likely to be big. I mentioned no big new money coming by the end of the year, but we do see fiscal support to scale up over the coming year. So that's coming, but it might not come in one go, in one big bang. And second thing that has changed is how quickly the economy is going to turn around. We talked about the deep-rooted issues of local governments being constrained and the extended property market slump. That's going to take time to turn around. So we can expect the government definitely putting its full weight behind growth, and it's going to unveil various measures, but it's not going to happen overnight, the growth.
And Mark, truth of the matter is that China doesn't want to see those excessive gains in its markets, that speculative trading that we've seen before.
Yeah, I think that's very much true. I think they realise that they need to solve the situation, but they want to get away from boom and bust. They might struggle to do so. I think the market is going to force them to deliver more stimulus and more measures than they probably would ideally hope for, because they've realised that they do need to turn around sentiment for now. And I think that's the point. I think that even if there are skeptics out there that feel that this is going to be another boom and bust situation, it would be folly to translate that meaning that you fight the boom period now. We're still early on in this this very clear signalling that they want to turn sentiment around, they want to turn the market around. Now, whether they calibrate it correctly to not create another bubble or not is a secondary issue. The point is they're going to drive asset prices overall higher in the coming months. Right. If what's been announced so far is not sufficient, they will announce more, but I think what they have announced is sufficient.
MLive Executive Editor Mark Cudmore, Bloomberg Chief Asia Economist Chang Shu, thank you so much for your insights today. Now, still to come, Indian inflation expected to jump in the latest reading, with economists forecasting a year-on-year expansion above 5%. We'll take a close look. Keep it here with us. This is Bloomberg. Welcome back. The collective of charities that indirectly controls India's $165 billion Tata Group has appointed Noel Tata as its new chairman. Tata Trust says the decision was unanimous and effective immediately. For more on Noel Tata and what's next for the conglomerate, let's bring in Bloomberg India senior editor Manika Doshi. Manika, what do we know about Noel? What does he bring?
Well, he's a Tata, so he brings the surname to the table. Besides that, he brings a long history of having worked in the group. He's the half-brother of Ratan Tata, which means they share a father. And Noel Tata has spearheaded the Trent Limited company of the Tata Group, which is a retail business and has done fairly well over the last several years. It is now, I think, the fourth or fifth most valuable company within the very large Tata Group. He is a quiet personality in the sense that he has not been in the public headlines for too long, often overshadowed by his more famous half-brother, which is Ratan Tata, but it's now his moment in the sun. Now, I'm going to make 3 or 4 very quick points because I know we're short of time this morning, but I'll tell you that it's a good thing that his appointment as the chairman of the Tata Trust was confirmed very quickly right after the demise of Ratan Tata, precluding any controversy around succession of the trust, which are in fact the key owners of the Tata Group. They own 66% in Tata Sons, which is a private entity, which in turn owns majority shareholdings in many of the Tata Group companies which are listed, such as Tata Steel, Tata Consultancy Services, Tata Motors, etc. Now, A, speed was important. B, that he's a Tata, as I mentioned, is important because trusts as a legal entity in India are susceptible or vulnerable to external influence, such as the charity commissioners, through which, the government can intervene in trusts. So it's good to have a Tata there because that sort of just makes, it legitimizes the succession in many ways and protects the trust from any external influence. 2 things to watch out for. 1, Noel Tata's working relationship with N. Chandrasekaran. He's the chairperson of Tata Sons, the private entity that controls the stakes in the various Tata Group companies. And he has been appointed for his second term in 2022 for 5 years, which means his term goes on till 2027. Chandra is, as we all know, a veteran Tata hand. He helped to build TCS into the giant that it is. And so that working relationship is going to be important to watch. The second thing important to watch is that Noel Tata is married to Alu Mistry, who is the daughter of Palonji Mistry. Now, Palonji Mistry's family is the second largest shareholder in Tata Sons. It has over 18% in shareholding in Tata Sons. This has been a point of dispute and unpleasantness between the two families in the recent past, especially with the expulsion of Cyrus Mistry as the previous chairman of Tata Sons. And so there is some hope that now this will all be resolved a little bit more amicably.
Manika, having put that in perspective for us, are we expecting continuity or might there be some changes?
There will be, to some extent, continuity in the purpose and the running of the trust because the Tatas have always believed in the philanthropic, sort of nature of their business ownership, and that we should expect. It is very difficult to predict what Noel Tata's vision will be for the Tata Group because it is not a vision we've heard him articulate in the past before. Like I pointed out, he has largely been a quiet player in this entire saga over the last several decades. So it is only now that we will know whether he has a different vision for the Tata Group as envisaged by his predecessor, or it is in alignment with what Ratan Tata has thought and therefore will mean, more continuity than change. That's something we need to watch for.
Manika Doshi, great insights. Thank you so much for that. Bloomberg India senior editor Manika Doshi. We're counting down to the India Open in just under 1 minute. You're, of course, watching India Focus. Let's do a check on where futures are pointing. Of course, we have losses for the rest of Asia in terms of the futures market in India. Let's take a look where we are, pointing to a higher open. The Sensex up by 0.2%. India releasing its inflation data for September on Monday. Bloomberg Economics believes CPI will probably show a temporary spike. Let's bring in Madhavi Arora, Chief Economist at MK Global Financial Services. Madhavi, your thoughts on where CPI might be?
Hi, Haslinda. Well, we are estimating CPI inflation to pick up pace to 5.11% in September after having printed sub 4%, which is 3.65% in August. This acceleration is likely driven by largely the reversal of base effect, which had earlier dragged inflation below 4% over July-August. Sequential price pressure, however, are not very substantial. So we are looking at headline CPI inflation rising around 0.2% month on month after having seen practically no change in August. In particular, what we're seeing is that there's been a seasonal price surge in perishable food prices, which largely was led by vegetable, which had softened in September, but you will be seeing pick up in egg, meat, and fish, and probably in certain segments of fruits and vegetable also, which could sort of lead to a moderate upside pressure in food CPI. That said, core inflation looks to be pretty sideways, very mild increase on a month-on-month basis, which means that core inflation would be probably just 2 or 3 bips higher than what we saw last month.
Right. It does seem like the RBI is comfortable with the CPI trajectory, especially on the back of what we saw tweaking or changing rather its stance from hawkish to neutral, opening the way for that rate hike. Or rate cut, rather. Yeah. I'm getting it all confused right here. And what are your thoughts on where we might see that rate cut?
RBI has kept its inflation forecast unchanged for a long time now. Mild tweaks here and there, as you said. But I think they've been wary of the potential spillover risk of higher food inflation to core prices, which we don't think would be the case because we, do not see core inflation moving about 4% in this fiscal year. And in fact, we're looking at it averaging around 3.75% in FY25. Which is largely led by weaker demand dynamics. Of course, there could be risk in terms of upside pressure on crude oil prices, which RBI also has taken around $80 per barrel for the second half of the year. So to a large extent, they are sort of pricing a 4.5% inflation for the year, which is not a big worry per se. I think the stance change, to be very honest, has been sort of perceived as a communication tool by the market for RBI to create space for cuts ahead. But RBI has been stressing on being actively disinflationary and have been largely on a wait and watch mode for assessing multiple macro forces. To be very fair, we are seeing a slower activity data on a high frequency basis. We are looking at a much slower growth than what we were 6 months ago. But I think at the same time, the bigger question that the RBI is now trying to sort of sort is the global dynamics. We saw the US Fed cutting 50 bips in the month of September, which did not get replicated by the Reserve Bank of India in October, largely because, we are also looking at upside surprises in growth, labor markets and inflation pressures in the West, which also is now again, sort of reigniting the higher for longer scenarios that people had stopped talking about altogether. Plus, we have the US election event, which is also a risk ahead in terms of how the financial stability across emerging market could really get disturbed via the FX route. At the same time, the geopolitical tension, which is just dragging way too much. So I think it's best for them to sort of wait and watch. December is thus a possibility that we can see a rate cut, but it's not 100% at this point in time. I think a lot of the
give us a sense of whether or not. Give us a sense of whether or not India's growth is resilient, because some talk about perhaps a slowdown, which can then be countered by rural demand, which can be countered by services in terms of urban demand as well.
You rightly said, because, post-COVID, there has been patchy growth. Of course, we have seen surprises on the growth front in the last 4 years or so. Every time we're just seeing upgrades on inflation than on growth rather than downgrades. But, if you look at the secular growth agents, be it consumption in the private sector, be it private investment, both have been largely missing in this, growth picture post-COVID. The first leg of growth was led by exports, both manufacturing as well as, services export, followed by public investment, which has been a big lever as well. But to a large extent, the private agents have been absent, and we're not seeing any signs of that really picking up. Rural consumption was a very dull story even pre-COVID. Post-COVID, it had actually gotten worse and sort of improved over the last 6 months or so. But it's been a cyclical improvement. There's still structural problems in the rural sector, which needs policy, support. At the same time, urban consumption, which was the bellwether of the consumption story in India post-COVID, he's now looking to sort of slow down because we are seeing income growth also coming off in the urban sector, job growth in the urban segment, especially IT and BFSI, which were leading the show, are looking to sort of fade. So I think the urban consumption story will also see a bit of a slowdown. So we're still looking at the economic agents on the private sector side to really pick up. Until the time we don't see private consumption really pick up, I really doubt that we will see private investment also taking suit or be a front lead in this particular growth cycle.
For growth to reach its potential, India needs to invest further in infrastructure, in training its workforce. Where will the money come from?
Well, to be very honest, policymakers are struggling with that problem because, to a large extent, our fiscal is constrained by some committed expenditure. Interest payment as a percent of GDP itself is now soaring close to 3.5%, 4%. And that's exactly why policymakers are also working towards improving the debt dynamics rather than focusing too much on the fiscal numbers. In fact, the finance minister even talked about targeting debt to GDP ratio going ahead instead of focusing too much on the fiscal deficit number. So clearly they are aware of these struggles. They are trying to clean their balance sheet so that they can actually go ahead and spend much more on segments which require investment in human capital. Of course, physical infra has been a lead by the government of India. They have done a fairly good job with regard to, front-loading their capital investment over the last 3 to 4 years. Even states have also joined suit by center. So I think somewhere the public sector story is played out well. Of course, we're waiting for the private sector to really, come on forward. But policymakers are aware of it. I think they're cleaning their balance sheets to ensure that the next leg of stimulus that they give will be much more focused towards human capital. That said, of course, the financial savings in India are also evolving, so that itself will give us a route to, create capital for the system to, invest more. And of course, we are opening up to the rest of the world, right? So that there will be foreign capital, which will also help us. But it's a long drawn story again. We're looking at around 7 to 10 years from now, wherein policymakers and, external financing could probably help us find our route towards potential growth.
Madhavi Arora, MK Global Financial Services, thank you so much for that. India's been trading for about 7 minutes now. We're seeing modest gains pretty much across the benchmarks. The Sensex index up about 0.3%. Let's do a check on HCL Tech and Reliance, how they're trading as we speak. At this point in time, those shares trading in the positive. I think the last view that I had, HCL Technologies up 0.2%, Reliance also in positive territory. We'll dig deeper into HCL Tech's earnings on Tuesday. CEO and Managing Director C. Vijayakumar will be joining us for an exclusive interview. That's 9 a.m. Mumbai time, 11:30 if you're in the Lion City. Plenty more ahead. This is Bloomberg.
Good morning from our world headquarters in New York. I'm Menace Krennic.
And I'm Danny Berger. Let's set your agenda.
Bloomberg Brief delivers the market news, data, and analysis you need live every weekday at 5 a.m. Eastern. Bloomberg. Context changes everything. The countdown is on. Everything you need to get the edge at the end of the market day.
Big tech earnings kick off later this afternoon.
Gilead is coming out right now.
We have Take Two numbers. Back to the markets, right? Our bread and butter.
NVIDIA is one of the best stories in the tech space.
That actually matters a whole lot more.
It might shock some of your viewers.
You're watching The Close.
Get ahead of tomorrow's trading with The Close. Weekdays on Bloomberg. Context changes everything. Bloomberg Surveillance covers the latest in global markets and the political events that influence your world. Join Jonathan Farrell, Lisa Abramowitz, and Anne-Marie Hordern only on Bloomberg. Context changes everything. It's a multi-trillion-dollar industry. We'll show you what's happening in ETFs like no one else. Bloomberg ETF IQ, Monday on Bloomberg.
tracking Chinese markets trading at session highs at this point in time. On the back of that briefing that which you had over the weekend, investors pretty much divided on that. Suffice to say, it's been a pretty volatile session for China in particular. The CSI gaining as much as 1.5%. It is where it is trading at this point in time. Investors mulling China's promise of more support for the property sector, also government borrowing to boost the economy. Banks, property plays in focus as we speak as well. We're keeping an eye on Chinese consumption stocks slumping on the like of stimulus specifics. We have 1.1 China currently down by more than 4% right now. Samsonite also in negative territory. Pretty disappointed with the lack of details from Saturday's briefing. That is it from Bloomberg Markets Asia. Horizons Middle East and Africa is next. Keep it here with us. This is Bloomberg.